Before we begin today's analysis, I want to invite you to join this community of thoughtful investors. If you value disciplined financial perspective over noise, measured insight over hype, please consider subscribing to this channel. Look for the red subscribe button below this video. Your presence here tells me you're serious about understanding markets, not just reacting to them. Now, let's discuss something significant that's unfolding in real time. Gold is moving. Not with the frantic energy of a speculative mania, not with the breathless headlines that typically accompany bubbles. It's moving with something far more significant: structural inevitability. As this analysis goes live, gold has already broken through multiple resistance levels that analysts spent years identifying. Central banks are accumulating at rates not seen in decades. Institutional money that ignored precious metals for years is quietly repositioning. And here's what matters most. The fundamental drivers behind this movement haven't even fully materialized yet. When insiders, central bankers, sovereign wealth managers, institutional allocators say we're still early, they're not making predictions. They're reading the same macroeconomic data you have access to. They're simply willing to acknowledge what that data implies. This is not speculation. This is preparation. Today, we're going to walk through why the gold thesis has fundamentally changed, why the comparison to bubbles is not just wrong, but dangerously misleading, and what this means for your portfolio, whether you currently hold gold or not. This will take time to explain properly. There are no shortcuts to genuine understanding, but if you stay with me, you'll finish this analysis with clarity that most investors won't develop until it's far too late to position themselves effectively. Let's start with a critical distinction. When people hear 5,000 gold, many immediately think bubble. They remember Bitcoin at 60,000. They recall tech stocks in 2000. They've been conditioned to believe that large price movements equal irrational exuberance. This reflexive skepticism is usually healthy. Markets do produce bubbles, investors do get carried away. But not every significant price movement is a bubble. Some are repricing events. What's the difference? A bubble is characterized by detachment from fundamentals, parabolic price action driven purely by speculation, widespread public participation based on getting rich quickly, and leverage amplifying movement in both directions. A repricing event is different. It occurs when an asset's price adjusts to reflect changed fundamental realities. It's driven by institutional recognition of altered conditions. It happens gradually, then suddenly, and it's typically accompanied by skepticism even as it unfolds. Gold is experiencing a repricing event. The fundamentals that kept gold range-bound for years have changed. The monetary environment has shifted. The geopolitical landscape has been restructured. The relationship between governments, central banks, and currency itself is being redefined. These are not minor adjustments. These are tectonic shifts. Understanding where gold might be going requires understanding where it's been. Gold isn't a speculative asset. It's a 5,000-year-old technology for storing value across time and space. For most of human history, gold was money, not a commodity, not an investment. Money. The anomaly isn't gold's current rise. The anomaly was the 40-year period when gold was relegated to the sidelines of the financial system. From the 1980s through the 2010s, gold existed in a specific macroeconomic context: declining inflation, strengthening dollar, globalizing trade, expanding credit, and confidence in central bank management. In that environment, gold underperformed, not because it failed as an asset, but because the conditions that drive gold demand were absent. But those conditions are returning, not all at once, not in a straight line, but unmistakably. Consider gold's major repricing cycles. In the 1970s, gold went from $35 to $850 as inflation surged and currency confidence eroded. That's a 24x increase. From 2001 to 2011, gold rose from $250 to $1,900 as financial crisis exposed leverage and debt sustainability concerns. That's a 7.68x increase. Notice something? These weren't bubbles that collapsed back to starting points. They were repricing events that established new baseline ranges. Gold never went back to $35 after the 1970s. It never went back to $250 after 2008. Why? Because the fundamental conditions that drove repricing remained in place, even if temporarily obscured. Now, let's examine the present moment with clear eyes. The global financial system is navigating challenges that have no modern precedent. Debt levels across developed economies have reached saturation points. The United States holds over $35 trillion in federal debt, with deficits exceeding $1 trillion annually regardless of economic growth. Japan's debt to GDP exceeds 260%. European nations face similar constraints. This isn't political commentary, this is mathematics. When debt reaches these levels, governments face limited options: default, inflate, or financially repress savers. Default is politically unacceptable. Financial repression is already occurring through negative real interest rates. That leaves inflation, gradual currency devaluation, as the path of least resistance. What does this mean for gold? Gold is the asset that benefits when currency confidence erodes, not because gold produces cash flow or earnings, but because gold is the thing currency is measured against when trust in currency itself becomes questionable. Central banks understand this perfectly. In 2022 and 2023, central banks purchased over 1,000 tons of gold annually, the highest level since data collection began. China, Russia, Turkey, India, Poland, nations diversifying away from dollar dependence are accumulating gold systematically. This isn't conspiracy. This is published data from the World Gold Council. Why would central banks, the institutions that create currency, be accumulating gold at record rates? Because they see what's coming. They see unsustainable debt dynamics. They see weaponization of currency systems. They see fragmentation of global trade. They see inflation that may prove stickier than markets anticipate. And they're preparing. Let's address the bubble question directly. Bubbles require euphoria. Where is the euphoria around gold? Ask 10 people on the street about cryptocurrency, and most will have heard of it. Many will have opinions. Some will have bought it. Ask those same 10 people about gold, and you'll get indifference. Gold is boring. It's what your grandfather owned. It doesn't have apps or influencers or memes. This psychological indifference is precisely why gold is not in a bubble. Bubbles happen when everyone knows about something and wants in. Gold is rising while most investors remain unaware or actively hostile to the idea. Consider the participation levels. Retail gold ownership in Western markets remains near historic lows. Most investors under 40 have never owned physical gold. Pension funds and endowments remain dramatically underweight compared to historical norms. This is the opposite of bubble psychology. Furthermore, examine the price action. Gold has been consolidating and building bases, moving higher, yes, but without the parabolic acceleration that characterizes manias. In the 1970s bubble peak, gold rose 250% in 18 months. In 2011, it rose 70% in 6 months. Those are bubble movements. Current gold appreciation, while significant, has been measured. Even at elevated levels, gold shows none of the technical signatures of blow-off tops. But here's the most important point. Gold isn't rising because of speculation. It's rising because the alternatives are becoming less attractive. When real interest rates are negative or minimal, holding currency loses value. When equity valuations reach extremes, risk-adjusted returns diminish. When bond yields fail to compensate for inflation, fixed income becomes a guaranteed loss. In this environment, gold isn't a speculative bet. It's the rational alternative. Understanding market cycles is essential for maintaining discipline. Markets move in patterns, not because the patterns themselves have power, but because human psychology is consistent. There are 4 phases to any major market cycle: accumulation, markup, distribution, and markdown. Gold completed a markdown phase from 2011 to 2015, declining from peaks as central banks convinced markets they had inflation under control. From 2015 to 2019, gold entered accumulation. Smart money, central banks, family offices, institutional allocators, quietly built positions, while most investors looked elsewhere. In 2020, markup began. Gold broke through resistance levels that had held for years, but then it stalled, consolidating gains while narratives about inflation being transitory dominated headlines. Now we're likely in the middle phase of markup. Not the beginning, not the end. The middle. This is actually the most difficult phase psychologically. Early adopters feel vindicated but question whether to take profits. Those who missed early moves feel frustrated but aren't sure if entry now means buying high. The majority remains skeptical, waiting for confirmation that never feels quite convincing enough. This psychological uncertainty is precisely what you should expect mid-cycle. If this were a late-cycle bubble, everyone would be certain. Commentary would be uniformly bullish. Your neighbors would be discussing gold at dinner parties. Financial advisors would be recommending maximum allocation. None of that is happening. Let's discuss something most analysis overlooks. Gold isn't actually rising. Currencies are falling. This distinction matters. When you see gold hits new highs, what you're actually seeing is currency purchasing power declining relative to a fixed commodity. Gold doesn't change. An ounce today has the same physical properties as an ounce 100 years ago. But currency? Currency is whatever central banks say it is, and what they're saying, through their actions, is that currency supply will continue expanding. The Federal Reserve's balance sheet expanded from under $1 trillion in 2008 to nearly $9 trillion by 2022. The European Central Bank, Bank of Japan, and other major central banks followed similar paths. This isn't criticism. In the face of financial crisis and pandemic, expansion may have been necessary, but consequences exist, whether we acknowledge them or not. Every additional unit of currency created dilutes the value of existing units. This is basic supply and demand. If dollars or euros or yen increase faster than economic output, each unit purchases less. Gold is the measuring stick that reveals this devaluation. Over the past 20 years, gold has risen approximately 600% in dollar terms. But gold didn't change. The dollar's purchasing power declined, and gold's price in dollars adjusted accordingly. Looking forward, the structural factors driving currency creation remain in place. Aging demographics requiring healthcare and pensions, geopolitical tensions demanding defense spending, infrastructure needs, and debt service that grows with every rate increase. These pressures don't resolve themselves, they intensify. Now, let's examine what sophisticated investors are actually doing. Smart money doesn't announce its positioning. It quietly accumulates, preferring to buy without competition. But we can see the fingerprints of institutional involvement in gold. Central bank purchases, as mentioned, exceed 1,000 tons annually. Sovereign wealth funds have increased gold allocations. University endowments that hadn't touched gold in decades are establishing positions. Why now? Because portfolio managers understand a concept called correlation. In diversified portfolios, you want assets that don't move in lockstep. When stocks decline, you want something that holds value or rises. For years, bonds served this function. When stocks fell, bonds rallied, balancing portfolios. But that relationship has become unreliable. In 2022, stocks and bonds both declined significantly, a simultaneous fall that devastated balanced portfolios. Gold, meanwhile, held relatively stable. It didn't spike dramatically, but it didn't collapse with everything else. This performance during stress is what institutional investors value. Gold isn't in portfolios to maximize returns. It's there to survive what stocks and bonds can't. Ray Dalio has spoken extensively about holding gold as part of an all-weather portfolio. Stanley Druckenmiller increased gold positions, citing currency concerns. Paul Tudor Jones recommended gold allocation as inflation insurance. These aren't gold bugs. These are legendary investors who built fortunes through disciplined risk management. When such investors agree on positioning, which is rare, attention should be paid. We must also acknowledge the geopolitical dimension. For 80 years, global trade operated within a dollar-centric system. Oil priced in dollars, international reserves held in dollars, trade settlements conducted in dollars. This system is fracturing, not collapsing, not disappearing overnight, but fracturing. China and Russia are conducting bilateral trade in yuan and rubles. Saudi Arabia is accepting yuan for oil. BRICS nations are exploring alternative settlement mechanisms. Countries holding massive dollar reserves are diversifying. Again, this isn't political commentary. This is observable activity. When the dollar's role as exclusive reserve currency diminishes, even marginally, the implications are profound. Nations previously forced to hold dollars for trade will need alternatives. Gold is the most liquid, broadly accepted alternative that exists. This doesn't require the dollar to collapse. Even modest diversification from dollar dependence drives enormous gold demand at the margin. Consider the scale. Global currency reserves total approximately $12 trillion. If just 5% of that diversifies toward gold, that's $600 billion in new demand for an asset with annual mine supply of approximately $100 billion at current prices. The math is straightforward. If you currently hold gold, you face specific decisions. First, understand why you own it. If gold was purchased as portfolio insurance, protection against monetary instability, then current prices don't change the rationale. The insurance is performing as designed. If gold was purchased as a speculation, betting on price appreciation, then you must decide whether current levels represent value or excess. But I would suggest that framing gold as speculation misunderstands its function. The disciplined approach for existing holders involves several considerations. Avoid the temptation to trade actively. Gold's volatility can be significant. Attempting to sell rallies and buy dips usually results in worse outcomes than simply holding position. Transaction costs, timing errors, and tax implications erode returns. Consider your total allocation. Financial wisdom suggests gold should represent 5 to 15% of a diversified portfolio. If gold's appreciation has pushed your allocation above comfortable levels, rebalancing may be appropriate, not to abandon gold, but to maintain balance. Don't allow recent gains to justify larger allocation than your risk tolerance supports. Discipline means maintaining strategy regardless of recent performance. For those holding physical gold, ensure storage remains secure. As values increase, so does the importance of proper custody, whether safe deposit boxes, home safes, or allocated storage through reputable dealers. Document your holdings. Maintain purchase records. Understand tax implications if sale becomes necessary. But most importantly, revisit your original thesis. Are the reasons you bought gold still valid? If anything, debt levels are higher, monetary policy is more expansive, and geopolitical fragmentation is more pronounced than when many investors initially purchased gold. If your thesis remains intact, current prices shouldn't trigger panic selling. They should reinforce conviction. If you don't currently own gold, you face different questions. The first is whether gold belongs in your portfolio at all. This depends on your investment timeline, risk tolerance, and existing allocations. Gold produces no income. It pays no dividend. It generates no cash flow. Its entire value proposition is purchasing power preservation across time. If you're young, with decades before retirement, and comfortable with equity volatility, gold may be less essential. Time allows recovery from market downturns. If you're approaching retirement, concerned about preserving wealth, or hold significant bond allocations, gold deserves serious consideration. The diversification benefits become more valuable as time horizon shortens. But let's address the elephant in the room. Is it too late? This is the question everyone who missed early positioning asks. Here's the honest answer. We don't know what short-term price action will be. Gold could consolidate at current levels for months. It could correct sharply before continuing higher. It could accelerate in the near term. Short-term unpredictability is why timing markets fails. But if we're correct about the underlying fundamentals, if debt dynamics, currency devaluation, and geopolitical restructuring are real, then current prices may look reasonable years from now. The alternative is waiting for perfect clarity. And perfect clarity arrives precisely when opportunities disappear. Consider a measured approach. Rather than attempting to time a perfect entry, build positions gradually. Dollar cost averaging into gold over 6 or 12 months reduces the impact of near-term volatility. Start with a modest allocation, perhaps 5% of investable assets. This provides meaningful exposure without excessive concentration risk. Choose your vehicle carefully. Physical gold offers direct ownership but requires storage. Gold ETFs provide no liquidity and convenience but introduce counterparty risk. Gold mining stocks offer leverage to gold prices but add company-specific risk. For most investors, a combination makes sense. Core holdings in physical or ETF gold with selective mining exposure for those comfortable with additional volatility. And critically, view gold as long-term position, not a trading vehicle. The value of gold is realized over years, not months. Now we need to discuss what not to do. Even sound investment theses can be destroyed by poor execution. Gold is no exception. The greatest returns and worst losses in investing come from emotional reactions. Buying gold after reading a panic-inducing headline about currency collapse is reactive. Selling gold after a sharp correction because fear overwhelms you is reactive. Discipline means making decisions based on research and strategy, not fear or greed. Some investors, once convinced of gold's value, allocate 50, 70, even 100% of portfolios to gold. This is dangerous. No single asset, regardless of conviction, should dominate your portfolio. Concentration creates vulnerability. If you're wrong about timing, about fundamentals, about anything, recovery becomes impossible. Diversification isn't lack of conviction. It's risk management. Leverage amplifies gains, but also amplifies losses. Buying gold with borrowed money or using leveraged gold products introduces failure risk that standalone gold positions don't have. Gold's value is its stability during chaos. Leverage destroys that stability, turning insurance into speculation. If gold rises sharply in a short period, resist the urge to dramatically increase positions. This is when risk is highest. Parabolic moves either consolidate or reverse. Buying strength feels comfortable but often precedes pain. Better to build positions during boring, frustrating periods when gold moves sideways and narratives turn negative. Physical gold requires proper storage. Home storage needs adequate safes and often insurance. Bank storage needs reliable institutions. Casual storage in dresser drawers or basement boxes is asking for loss. Similarly, sharing details about gold holdings creates security risk. Discretion protects you. In many jurisdictions, gold is taxed as collectible at higher rates than stocks or bonds. Understanding tax treatment before selling prevents unpleasant surprises. Some dealers sell collectible or rare coins at substantial premiums above gold content value. Unless you're a serious collector, pay for gold weight, not rarity. Standard bullion coins or bars provide exposure without unnecessary markup. The flip side of emotional reaction is overthinking. Some investors research endlessly, waiting for perfect information that never arrives. At some point, if gold fits your strategy, establishing position matters more than finding the perfect entry point. Gold doesn't have earnings reports or management teams or growth projections. Technical analysis and fundamental analysis apply differently. Expectations should match gold's actual characteristics, not stock market norms. Gold's potential doesn't make stocks, bonds, or real estate worthless. Each asset class serves different functions. A rising gold thesis should inform allocation, not eliminate diversification. Gold's movement isn't isolated. It's part of a broader market message. When gold, treasury bonds, and certain commodities move simultaneously, markets are signaling uncertainty about future monetary conditions. When gold rises while stocks remain elevated, markets are suggesting that asset inflation may continue even as real economic growth questions linger. These signals deserve interpretation, not dismissal. Markets are imperfect information processors. They overshoot, undershoot, and sometimes ignore reality entirely. But over time, markets reflect fundamental truths. And right now, markets are saying something important about currency, debt, and purchasing power. Investors have choices in how to respond. Ignore the signal and maintain status quo allocations. Acknowledge the signal but wait for more data. Or recognize the signal and adjust positioning accordingly. None of these choices is inherently wrong, but each carries different risk profiles. Ignoring signals works perfectly until it doesn't. Waiting for certainty means acting after the fact. Adjusting proactively means acting on incomplete information. The disciplined approach likely sits between extremes. Acknowledge uncertainty while preparing for multiple outcomes. We should discuss what realistic outcomes actually look like. If gold does reach significantly higher levels, and that remains an if, not a guarantee, the path won't be smooth. Expect volatility. Expect drawdowns of 10, 15, even 20% along the way. Expect periods where gold seems to do nothing while other assets shine. Expect narratives to shift from bullish to bearish and back again. This is normal market behavior. The question isn't whether volatility will occur. It will. The question is whether you can maintain discipline through volatility. Most investors fail not because they choose wrong assets, but because they abandon correct positions at wrong times. They buy high, feeling confident as momentum builds. They sell low, feeling foolish as declines persist. The emotional toll of volatility exceeds the financial toll for those who hold long term. So prepare yourself mentally. If you establish gold positions, write down your reasoning. Keep that document. When prices fall and doubt creeps in, review your original thesis. Has anything fundamental changed? If not, volatility is noise, not signal. Also understand that gold's rise, if it continues, won't make you wealthy overnight. Wealth building requires time, discipline, and compound growth across multiple asset classes. Gold's role is preservation and diversification, not lottery ticket wealth creation. Set appropriate expectations now, and you'll avoid disappointment later. Everything discussed today requires something scarce: discipline. Discipline to research before acting. Discipline to act despite uncertainty. Discipline to hold through volatility. Discipline to avoid emotional extremes. Discipline to maintain perspective. This is harder than it sounds. Our brains aren't wired for good investing. We're wired for survival. We panic at losses. We chase gains. We seek patterns where none exist. We convince ourselves that this time is different or that things will never change. Effective investing means overriding these instincts. It means buying insurance before the fire, not during. It means diversifying when concentration feels more exciting. It means patience when action feels urgent. If you're not prepared to exercise discipline, gold, or any investment will disappoint you, not because the asset failed, but because you did. So before taking any action based on today's analysis, ask yourself honestly, can I hold through a 20% decline without panicking? Can I avoid checking prices daily? Can I maintain allocation through years of boring sideways movement? If the answer is no, reconsider your approach. Perhaps smaller allocation makes sense. Perhaps waiting until you've developed emotional readiness is wiser. Perhaps gold isn't appropriate for you at all. There's no shame in honest self-assessment. There's great shame in losing money because you misjudged your own psychology. Let's bring this together. Gold is experiencing what appears to be a fundamental repricing, not a speculative bubble. The drivers are structural: debt, monetary policy, geopolitical shifts, and currency concerns. Insiders, central banks, and sophisticated institutions are positioning as if early innings remain in this cycle. Their actions suggest conviction that current prices don't fully reflect future realities, but outcomes remain uncertain. Markets are complex, adaptive systems. Predictions, even well-reasoned ones, fail regularly. So what should you do? If gold fits your financial strategy, risk tolerance, and time horizon, establish appropriate positions with discipline. Build gradually, diversify properly, and prepare mentally for volatility. If gold doesn't fit your situation, that's perfectly acceptable. Not every investor needs every asset. Understand the thesis, file it away, and revisit if circumstances change. But whatever you decide from a place of calm analysis, not fear or greed. The future will unfold whether we're positioned for it or not. Our job isn't predicting that future with certainty. No one can. Our job is preparing portfolios to survive multiple possible futures. Gold represents one element of that preparation. Not the only element, not even necessarily the most important element, but an element worth understanding. Years from now, you'll judge today's decisions, not by whether gold reached specific price levels, but by whether you acted with discipline, wisdom, and appropriate risk management. Markets will do what markets do. Your responsibility is ensuring you're positioned to weather whatever comes, opportunities and challenges alike. Thank you for investing this time in serious financial education. If this analysis helped clarify your thinking about gold, monetary conditions, or portfolio strategy, consider sharing it with others who value thoughtful perspective. Remember that red subscribe button we mentioned at the start? If you haven't subscribed yet, now would be a good time. This channel exists to provide the kind of measured, disciplined analysis that helps you make better long-term decisions. No hype, no guarantees, no get-rich-quick promises, just honest examination of market conditions and rational discussion of what might lie ahead. Markets will continue evolving, new challenges will emerge, old patterns will repeat with slight variations. We'll be here, analyzing it all with the same calm, professional approach you've experienced today. Until next time, stay disciplined, stay diversified, and stay focused on what you can control, your own decision-making process. The rest will take care of itself.